Hello and welcome to Friends That Invest. You're joined today by your host, Sim Kaur. I'm a financial author and investor, and I'm here to help you learn all things investing and personal finance. Now, this week's episode is brought to you by the Investy Besties that have asked, when I get one or two requests, I'm like, oh yeah, that's a nice idea. But when I get so many requests to do an episode, I'm like, okay, I have to do it. It's what the besties asked for. And if I am here to do anything, it is to serve our investor community. The question that kept coming up was, Sim, there's this podcast that came out on the Diary of a CEO where this investing professional basically seems to be saying, pull your money out of the US, dump your money into emerging markets, and that the US is going to collapse and yada, yada, yada. And to be honest, that's how it came across in just the snippet. But if you watch the whole episode, which I went ahead and did, I'm here to tell you that, long story short, there is nothing to panic about. But here are my reasons and my data sources of why I am not panicking. I am not selling down my S&P 500 shares. I am not moving my money out of the US market. And here are the reasons that you should consider to make your own decision. Because at the end of the day, things can go either way. You can listen and go, yep, that makes sense, Sim. I'll do X, Y, Z. Or you know what? Thank you for sharing these opinions, but I still don't feel comfortable investing in the US market. And to that, I go, amazing. Fantastic. At least you have the data to make your own decision, as opposed to fear-mongering from another podcast or fear-mongering from, snippets of a podcast, which can seem very, very, very heightened and very scary. So without further ado, here's reason number one why I am not scared about investing in the US market over the next 10 years. Reason number one is that the US is an innovation hub like nowhere else in the world. Let me give you some examples of companies that have been born out of the US that have fundamentally changed how we live day to day as humans in the Western world. From things like Airbnb to Uber to Apple to Microsoft to even OpenAI and Meta and Anthropic. These companies have been born out of the US, and there is a reason why they have mainly come from there as opposed to anywhere else in the world. And it is because the level of innovation that we see in the US market at this point in time, and in my opinion, over the next 10 years, is so unique to the US for one reason and one reason alone. Reason number one is that there is no place on earth where innovation runs so fast, moves so quickly, and has such a huge concentration of talent. If you were to ask any venture capitalist, any investor, or anyone that works with large scale companies, and you said to them, what differentiates a really, really successful company from its competitors? Because it's not the idea. It's not the person that came up with Google. It's not the person that came up with Airbnb. It's not the person that came up with Uber. Those companies could have been built from anywhere in the world. But the reason why they did well in the US to begin with is for one reason and one reason only, and that is talent. You can take any company in the world, but if it does not have really exceptional, world-class people working in those companies cannot scale because they cannot innovate and they cannot grow as fast enough. And the moat, or the unfair advantage that the US has, is it has a lot of very hardworking and very talented and very innovative people, either people that are domestic from the US or international workers that have gone, I'm the best in my country. The US is the quote unquote promised land. Let me move over and let me continue to help build and grow these companies. And that is why there is a disproportionate amount of world-class companies that have changed quite literally the way the Western world works. And they have all tend to have come from the US, literally beside Canva and Shopify, shout out Australia and Canada. But besides those companies, so many of the world's largest companies, from Google to Microsoft to Amazon to Anthropic or OpenAI or Apple or Uber and Airbnb, they have all come from the US. In fact, out of, I think, 10 of the world's largest publicly listed companies, most of them are US based, minus a couple of Chinese companies. It is honestly so interesting, and you'll probably noticed it as well. You're like, a lot of the world's largest companies tend to be from the US. But why is that? And it's literally just the way that these large scale companies understand innovation to a way that the rest of the world hasn't quite caught up with yet. And a good example of this is the Google 20% project. They had this idea at Google, at Alphabet, started in about 2004. And they said, you know what? For all the employees that work here, you guys do your job. Yay, fantastic. But what's really going to make us as a company do better is to continue to be innovative. So please spend at least 20% of your time doing side projects within the company, anything that you think could make the company better, or new projects or ideas. They don't have to be perfect, just try. And that is how some of Google's best products have come to the market. Things like Google AdSense was just someone's side project that ended up doing incredibly well. This one's speculative. Some people say Gmail was a side project. The founder of the Gmail platform says, no, it wasn't. So I'm not going to really use that as an example. But Google News was another part of Google that was just someone's side project. And if you think about two companies that do the exact same thing, Google, Bing, or Google and Yahoo search, there's a reason why one of them did really well. And it was the one that was the most innovative. It was the one that said, wait, we could make money from having ads on Google and also ads on YouTube. And we'll call it AdSense, and we can encourage creators or the publishers to make money, as well as get the advertisers in front of people in a way that's really natural. And it ended up being one of their largest sources of revenue, which allowed them to completely obliterate their competition. And at the end of the day, it came from innovation. It didn't come from a Larry Page being the smartest man on earth. It came from all the talented people that worked at this company that collectively innovated it and moved it forward. Now, the second reason, and honestly, guys, I am so scared that I'm going to sound like an American apologist by the end of this episode, but the whole reason for this episode is to help you not freak out and go, oh my God, I listened to this other podcast. I need to sell all my US shares. Just take a deep breath, one step at a time. I'm just going to share you facts and figures on reasons why I do not believe the US market is going to fall and crumble within the next couple of years or the next decade or even the next 20 years. After that, look, it's anyone's guess. But this is what the facts and figures say. And the second reason why I don't believe that the US market is going anywhere, and remember, it's important to understand the US share market is not the same thing as the US economy. The economy is made up of things like job unemployment. It's made up of things like consumer spending and inflation. Whereas the share market is made up of publicly listed companies and it's made up of investors. And so that's what I'm referencing here. So economy, I'm not sure. No one really knows. But the S&P 500, the top 500 companies within the US that make up that market, I feel very bullish, which is just a jargon way of saying I feel very confident in their long-term growth. Not in the next 2 years, not in the next 5 years. No one knows what's going to happen then. But the next 10 years, 20 years, 30 years, these are the reasons and these are the data points that support this argument. And the second reason being is that the US has such a huge amount of capital available to fund startups. And this is in a way that is completely unmatched from the rest of the world. So let me give you an example. US startups, so companies that are not public yet, that are private companies that may one day go ahead and IPO, received $412.7 billion, not $400 million, $400 billion, $0.4 trillion in venture funding, so private capital, private money from private investors in just the first 6 months of this year, not even over the whole year. That is a huge amount of money. And the reason why this is important to understand is that in the private market, if you are comparing the US private market to maybe China, to maybe Japan or Korea, what the US has that these other countries don't have yet is they have so much wealth accumulation, and so much of that wealth accumulation goes back into the startup world. And so if you are a young founder and you're like, I'm going to start the next Uber for pets, or I'm going to start the next Poppy, or I'm going to start the next big thing. If you go to a US investor, they can very easily give you hundreds of millions of dollars, even billions of dollars. And you can build your company very, very quickly, because sometimes in venture, the biggest and fastest growing companies are the ones that can raise the most amount of money. Now, this can sound confusing if you're comparing it to like a software company, but imagine you are trying to build the next like Waymo competitor. You're trying to build the next autonomous vehicle. To do that, you need a lot of money up front, because you need to pay for the hardware, you need to pay for the software, you need to pay for the like world-class engineers. You need to get them to agree to move away from, I don't know, like Meta or Airbnb and Uber and come work for your company. And they're earning like $300,000 a year or $200,000 a year. So you need to pay them really good salaries. So the company that does well is the company that can raise the most amount of money, deploy that money very quickly into employees, into growing the business, and basically be the first to capture the largest proportion of the market. A good example of this is Uber. Uber is not the only company that came out with, hey, let's like do taxis, but like on a phone. But because they had venture funding and they had a lot of capital behind them, they could grow very, very quickly, go from like, 100 staff to 1,000 staff to 10,000 staff. They could grow very, very fast and then capture the market. And once you capture the market, like consumers are lazy. Once you stick to something, it's very hard to get them to switch to something else. They get loyal to a brand. And that's why we have this thing called first movers advantage, where if you're the first company, not always, but if you're one of the first companies, you can kind of get people to trust you a lot faster. And honestly, I feel like that's half the reason why Friends at Invest has done well. We were just one of the first companies to go, hey, women should invest. This is how you do it. And it's not because we were like better than anyone else. We were just one of the first. But I digress. This is not an episode about me. It is about raising capital. And when you have such an easy ability to do that in the US, and it will always be seen as like the gold standard place to get money, then you just have an unfair advantage where why would a company or a startup want to build anywhere else if not the US? And we see this even in New Zealand. I've invested in a lot of New Zealand-based startups. For example, I am an investor in a company called Halter, and I'm an investor in a company called Tracksuit. And both of these companies have started off in New Zealand, raised New Zealand private money from angel investors, from venture fund investors, from limited partners like myself. And then they have gone ahead and moved to the US and then looked for US money to keep growing, because, in the New Zealand market, maybe they can get $1 million, $2 million, $10 million. In the US market, like Halter reached $1 billion valuation. And that is so impressive, but that probably would have been very hard to do in New Zealand. And on top of that, what the US gives them that they couldn't get from these other emerging markets is not only do they get more capital, they also get connections. The companies that invest in them end up saying, hey, sure, like we'll give you money and let me connect you to this person and let me connect you to that person. And so they have access to capital and connections that are far more valuable in terms of growing that company faster. And it's just going to be happening in the US for a very long period of time, unless all the money moves out and goes somewhere else. But where would it go? Now, the third reason why I'm not worried is there's this thing called liquidity. In the same way that there's unmatched amount of capital, there's also an unmatched level of liquidity within the US. Liquidity is just a fancy way of saying, I have some shares invested, and if I want to sell my shares, will there be someone else on the other side that wants to buy my shares at the exact same time? So an example of an illiquid asset is a house. If I want to sell my house, I have to wait for someone else to buy my home, and that can take a lot of time because I need to get a real estate agent. I then need to have an open home. People will come and negotiate. Then that person has to go get a bank approval. And it can take months between the point that I want to sell my house and me receiving that cash of my house in my bank account. Low liquidity. Now, something that's a lot liquid is something like shares, where if I sell my share, I can hopefully get that money today. But that's not always the case, and it depends on the liquidity of the share market. So the US share market is a highly liquid place to have your money, because if you sell something, there are so many other people, companies, funds, institutional investors that want to buy or sell at the same time as you. And so the time between you buying and selling something is very minimal. Now, let me give you like a real life example. The total value of US liquid equities is roughly $75 trillion to $78 trillion. This is more than double the next largest regional market. And because of the sheer number of participants from retail investors, pension funds, sovereign wealth funds, market makers, we are all buying and selling within the same pool. And so in simple terms, the more liquid a market is, the harder it becomes for the market to be manipulated or moved by things other than just like sheer, genuine information. Let me say that again. In the US market, if the market moves, it's not because a few handful of wealthy investors or whales that have lots of money in the market buy and sell. Because if tomorrow, like someone with $10 million decided to sell their shares of SpaceX, that wouldn't cause the market to move as much as if SpaceX was listed in Australia or in New Zealand or in the UK. Because their markets are smaller, it's like if you have a rock and you put a little pebble, a little rock into a bucket, it's going to cause a splash. And that can cause an impact on the rest of the investors because there's not as many people. But if you have a flat lake and you drop a single pebble in the middle of the lake, the impact that's going to have on the rest of the lake, the sort of, waves or ripples that come from it are very, very tiny because the lake is so big. And so the US is this big lake and smaller markets are like buckets. And the movement of large amounts of money is the pebble. And that's why it is seen as almost not safer, but perhaps less likely to be manipulated and therefore safer and therefore more fair as a market compared to other markets that are still growing and emerging because they just don't have as much capital in them. Now, the fourth and final reason, and this is the one that probably will surprise people the most, is oftentimes people go, Sim, I want to invest in the US market, but I also want to invest in emerging markets because like other economies are growing and they're growing fast and I want to tap into that. But what you'll be surprised to know is that many US companies are multinationals, and multinationals are just a fancy way of saying they operate in different countries too. For example, McDonald's. McDonald's is a company that is US owned and operated, but they also have their operations in many different countries. And so they have consumers of different countries. And so they get to tap in to the growing GDP of a country by tapping into the consumers and essentially getting the consumers to buy their product and then shipping the profits of that back into the US. So this might surprise you. Roughly 41% of S&P 500 revenue on a market cap weighted basis comes from outside the US, meaning the actual business behind the ticker are selling into European, Asian, and emerging market consumers every day, regardless of if you buy a single foreign listed company. So you can have access to emerging market consumers without needing to access emerging market companies. And that allows you to balance out reach growth, but without having to have the risk of emerging markets. Now, you might be listening to this and going, okay, Sim, like I hear you. That makes sense. Like there's a global diversification of consumers. There's unmatched liquidity. There's unmatched capital. And the US is a huge innovation hub. I understand that. But what if I still want to invest in emerging markets? And to that, I say that is such a good idea. And that is why we've always spoken about the lazy fund portfolio or the 3-fund portfolio or the bogglehead portfolio, where you invest in 3 different funds. Ow. For those listening and not watching, I just hit my funny bone. But essentially, you've got your 3 portfolios and you've got your US fund, you've got your international excluding the US fund, and you've got your bond fund. And this international fund, like VUE, is a total world international fund minus the US. And so it allows you to invest in these emerging markets because it's good to invest in other countries. It's good to have those options, but it doesn't mean you have to sell down your S&P 500 stocks and buy all the international funds that you can find, I think that's actually a very short-sighted approach, because that's in reaction to what's happening in the US market right now. And smart investors, long-term investors, investors in training, understand that we're not going to look at what's happening currently as a prediction of what's going to happen in the future. And we know that past performance does not guarantee future success. But we also know that diversification is a good thing. So by diversifying in emerging markets, that was always a plan. We've always been doing that. But to sell down your entire US funds to put into emerging markets doesn't seem like a good long-term strategy unless you are so confident that the US empire is going to fall. But for that to happen, all these large companies, from Airbnb to Google to Microsoft to Meta, all of their employees, all of their teams, all of their customers, it all has to collapse 500 times across 500 companies. That is a very, very, very unlikely scenario. And if it does happen, we probably have much worse concerns on our hand, not to be a little bit grim, but probably the end of civilization. At that point, I'm probably not worried about logging into CNBC and seeing what the market is doing. And so with that, I hope you've found this episode helpful. I hope you've felt a little bit more relaxed and not as worried. And if you've found this useful, then please take a screenshot, put it on your Instagram story, tag friends that invest. It is the best way for us to get the podcast to grow and reach more people, because what more can we ask for than a world where more women learn about investing, get better with their money, and live happier, healthier lives. So with that, I'll see you next week.